That worked.
All right, are we on?
Yep.
There we go. Want to welcome everybody. It is Thursday at 9 o'clock, and Investing Education Academy is coming to you to talk about value investing today. A lot of us think we know about value investing. Some of us are curious about value investing. Bottom line is, it's a way to invest. It's a strategy that we can use to increase our passive income and to really get involved with the market in a way maybe we're not used to. So we're going to dive into it today. If you have questions, please let us know. Leon and I, we will be giving you everything we can for the next few minutes that we're going to be on this live. Please take this moment, share it with friends. We're starting to get a lot of people ask if their kids can watch or can they forward this to parents. Of course you can. You can forward this to whoever you like. So please share it. And while Leon is giving us an overview of what we're going to cover today, I'm going to do some housekeeping.
Yes. So as Brent said, we're going to cover value investing. And so there are actually two primary ways that 95% of investors invest. It's either value investing or growth investing. We're going to cover value investing today. Either next week or maybe the following week, we're going to cover growth investing. Those are the two main strategies. But tonight we're going to cover value investing. So Brent, you can throw up slide one.
Yep.
So I'm just going to kind of read off it. So value investing is an investment strategy that involves picking stocks that appear underpriced by some form of fundamental analysis. And basically what that means is, so a lot of people come to Brent and I, and they're often saying, how do you value, how do you know if a stock has value? Is it overpriced or is it underpriced? How do you know, right? And that inherently is asking, what is the value of the stock? If you're asking me, I have my way of checking for value. You ask Brent, he has his way. You ask a million people, you probably get a million different ways to judge value. But ultimately, value investing is looking for a stock that is undervalued by however you define value, right? So you start with this slide here is showing, again, gave you the definition I just ran. So it's typically done via, values usually judged via earnings, assets, or cash flow when you're doing it fundamentally. And fundamentally just means with the company's fundamentals, which is usually like it says, cash flow, earnings, profits, things like that. So tonight we're going to focus on the one that 99.99% of investors use, which is earnings. Cash flow that's a whole different, that's something called discounted cash flow. Tons of numbers and tons of math with that. We're not touching that. And assets covers book value, typically book value. We may go into that later at some point, but for now, we're not going to touch that one either. We're going to just stick with earnings, which is the simplest way to value a company, to give it value. So below that, you see price to earnings ratio is what we're going to use. So just the definition of it, PE is a ratio for valuing a company based on the company's share price relative to its earnings, right? And what that means is it's pretty simple. So if you have a company that say has a PE of 50, right? And it has PE of 50. So basically what PE tells you is, it tells you how much you're going to pay for every $1 a company earns, right? So when you buy the stock, and don't worry about the math behind it, just get the concept. PE tells you how much you're going to pay for every $1 a company earns, right? So if a company has a PE of 50, that means when you buy that stock, you're essentially paying $50 for every $1 that company earns, makes in earnings. Now, relative to that, if you have a company that has a PE of 20, that means you're paying $20 for every $1 that company earns. So,
hey, Leon, real quick.
Oh yeah, go ahead.
So Leon and I were talking before we went into the live about the way Warren Buffett used to invest, right? So when Warren Buffett was like the guy, everybody went to Warren Buffett for his strategy. He was a value investor, and what he would do, he would try to find companies that maybe had a valuation or their prices, their stock price was, let's say, $20, and he would try to contact the company or buy the stock in some form or fashion for $15. And that way he had a cash position in the stock of $5. And when, that was one of his strategies. Another one was he would try to find PEs that were like 10 or below. That ended with like Blockbuster and Netflix. I think that was the last time you saw really that type of design of a company where they had a PE of less than 10 and they were a strong company. Now, if you find a PE less than 10, you should either think the company is in dire straits or you have to be a very savvy investor to manipulate that stock in your benefit. So PE ratios now can be 20, 70. I mean, just crazy numbers, but it doesn't mean it's a bad company anymore. So this was a little piece of history, thought we'd share it because it kind of explains what it used to be and what it's not anymore.
Right. So yeah, so as Brent said, so value investing is the way Warren Buffett made his money. He used PEs, he used discounted cash flow. I mean, we're talking about Warren Buffett. He has all the money in the world. So he had a whole bunch of people working for him, doing all these strategies for him. But PE is one that he used, and as Brent said, he would look for PEs that were less than 10. Today, as this is showing, one thing, we're going to go over this, the examples below. But as you can see to the far right, bottom far right, the average stock inside the S&P 500, which is quote unquote the market, the average PE for an S&P 500 stock is 25. Now remember, as Brent said, Warren Buffett was looking for stocks that had PEs of like 10 or less. So it's really hard to now find companies with PEs that are 10 or less in that Warren Buffett day. And that's why PEs are really relative to something else. You can't just look at a PE alone and say, okay, this company has a PE of 50. Is it higher or low? You have to compare it to something else. So that's what we're doing here now. So as we're saying, just recap. Remember, the PE value is how much you're spending for every $1 that company earns in profits, right? So I have two examples here. One is Verizon. We all pretty much know Verizon, the big wireless carrier. Verizon currently has a PE ratio of 12, right? So, okay, is that high or low? Let's see. So to the right of that now, I have the wireless industry's PE. And what that's doing is basically taking an average of all the stocks inside the wireless industry and getting an average of their PEs. So the wireless industry's average PE is 28. So that shows you, as of right now, Verizon is trading at a discount to the industry, which is a good thing. If you're a value investor, you're looking for stocks that are quote unquote cheaper and expensive. Verizon, relative to its own industry, is cheap. Next to that now is the S&P 500. So as I said, the S&P 500's PE on average is 25. Again, Verizon's is 12. So Verizon, if you're a value investor, Verizon is a great stock because it's trading at a discount to its industry and trading at a discount to the S&P 500, which is the market. So that's one example of a relatively of a cheap PE, a relatively valuable stock that if you're a value investor.
Yeah, and also Verizon is a dividend paying stock as well.
Right, they pay. I think Verizon pays like a 4 or 5% dividend. So remember, dividends is kind of like the interest rate on the stock. You're going to get paid every year, no matter what the stock does, up or down. You're going to get that 4%. So with Verizon, you're looking at a relatively cheap stock by the value metric of PE relative to its industry and relative to the market, and it pays a high dividend. So yes. As far as value investing, Verizon is one of the stars for value investors.
And also, just to slide back in last week or a previous week's lesson, when you start looking at company, if you're doing evaluation based off of the PE, Verizon stands out. But then also, if you're looking at the dividend right now, we're talking about bank rates being at roughly 2%. So if you have a company that's a strong company, that's positioned well in the marketplace, and definitely has a huge market cap to still expand to, it's a great time to give some serious consideration to adding it to your portfolio, because you want to beat the banks. I mean, at the very least, anybody watching us, anybody who checks in with us, our goal is to get you all to change the way you look at investing, to change the way your money works for you. You are an employer. Your money, every dollar is an employee. How will you manage that employee? So just something to think about.
Right. And like Bruce said, beat the banks, but more importantly, we want to beat inflation. So remember, inflation has averaged 2 to 3% per year. Verizon pays, I think, a 4 to 5% dividend. So Verizon is a great dividend paying stock, as well as a great value stock, because again, it's cheaper. It's trading at a discount to its industry and a discount to the general market. Now below that is an example of a stock that has poor value relative to its PE. So Etsy. I don't know if people are familiar with Etsy, but Etsy is, how would you describe Etsy, Brent?
So Etsy is a platform that allows independent merchants to sell their goods. It's an alternative to Amazon. The thought was it's the indie place for retail sellers who are online.
Right. Yeah. It's kind of like it's more where the mom and pops go. They don't want to get in the whole ecosystem, the big world of Amazon. They can go to Etsy and more control their products and the prices.
But Etsy's changing. Let's be very clear.
Oh yeah, Etsy's grown. Like when Etsy first came out, yeah, they were the mom and pop shop. They still primarily are, but they're becoming a lot bigger, and the control people had before, because they're growing, is kind of going away. Kind of the same way Amazon was when they first started out. It was a bastion for mom and pops, and now it's not, because big boys have gotten on there. So Etsy's kind of going that route too. And Etsy, I think, has only been public for, I don't know, maybe a year or two, maybe less than.
I think it's maybe two or three.
Yeah, it's relatively new. But so remember the PE tells you how much you're paying for every $1 of profit a company makes, or earnings a company makes. So Etsy's PE, now look at the difference here. Etsy's PE is 113, right? Verizon's is 12, right? So that right there tells you that based on the PE ratio, Etsy is way overvalued relative to Verizon, way more expensive. Now, again, we're going to do Etsy compared to its industry. Etsy is part of the internet services industry. The industry trades, the PE for the industry is about 33. Again, Etsy is 113 PE. So Etsy is way more expensive than its own industry, and then way more expensive than the S&P 500, which again trades at a PE of 25. So what this is showing you is, one, Verizon is really cheap relative to its industry and relative to the market, and Etsy is really expensive relative to its industry and relative to the market. So if you're out there as a value investor, you've all been wondering, okay, how do I value stocks, or how do I value things looking for relative value to other markets or other industries? PE is a great way to do it. Now, I will say, some people hate PE. We're covering PE tonight. If you go to talk to somebody more about PE, some people may look at you, give you the side eye. Some people hate it. Some people think it's the devil. Some people think it's God. Right? So you have two. I mean, PE is I don't know why. PE is a very controversial metric. I don't know why, because all it does is tell you how much you're paying for every dollar that a company earns. But I think the problem is that a lot of people, like, this is the only tool they use. Some people say, okay, Verizon's PE is 12, I'm buying it. And there are a myriad of other metrics you need to weigh when you're buying a stock. But because PE is so simple, some people only use PE, and a lot of people get burned with it. So thinking back now, I think that's one of the reasons people kind of shy away from it, and some people love it just because it's simple. So
Leon, I think a lot of times investors, there's a couple of things about PE, right? PE is a big threat to people who are in the market and they're explain themselves as experts, but they don't know how to talk about PE. So then they just default to, it's not important. Then you have the people who, this is what they use to come up with their basis for whether they're going to buy into a stock or not. So they love PE, but also the nature of PE, it's just changed. So again, you go back to right around 2000, well, what would you say, like 2004?
For what?
The PE shift was starting to occur. Like, companies at that 10 and below were starting to no longer exist. And actually, right around the tech bubble, right around the tech boom, I should say.
I was about to say, what changed was tech stocks, because in the 90s, 2000s, PEs, because remember, your PE is how much you're paying for every dollars of a company earning. And stocks were going through the roof. Everyone, I would think, remembers the dot-com days when companies were trading at ridiculous valuations. Well, they actually didn't have any profits, or they were either negative profits or had very little profits. But their stocks were trading at like $300-400, and they were bringing in like $1 million a year. So that PE ratio was just astronomical. So that also gave PE a bad name, because we all know what happened with the dot-com days. In the early 2000s, it imploded, and then PE kind of got a little more in focus. People were saying, well, people ignored PE, and didn't realize PEs. Some PEs were like thousands. Like, some companies were trading a PE of thousands. So PE got a bad rap after the dot-com days, and that's why it kind of has a reputation today. To me, it's a fine metric. It tells you. I mean, it is what it is. It's not the end all be all, but it just gives you information.
Yeah, I mean, too, you look at some of these companies now that are basically defying gravity, if you will. Amazon, they have a PE ratio of roughly 120. So, by the days of truer value investing before the dot-coms, that didn't make sense for a company to have that type of valuation but still be growing. And so Now I think it's just people don't know what to believe. I think so. That would be my answer to that question. Is like, why is there so much contention around PE? People don't know what to believe.
Right. Yeah. Because in the past, PE before the .com days, PE was seen as this great metric. During the .com days, a lot of people ignored PE and got burned. And some people still looked at PE and was like, "Well, I don't care. It's all about momentum." So when it all imploded, PE got a bad rap. So
Yeah.
I mean, if you're using PE, remember all PE tells you is how much you're paying for every $1 of earnings and/or profits a company makes. Etsy's is 113, Verizon's is 12. That's it. I mean, that tells you right there that Etsy is a more expensive company relative to PE. Like I said, there are other ways to measure companies, but this is one of the most popular ways to look for value to do value investing, to look for companies that have PE trading less in their industry and less in the market. So don't think PE is the end all be all to anything. If you find a PE that you like, also do your research into the company's products, its management, its history, its profit and sales, things like that. But PE is just a good way to find, maybe a good starting point to find out how valuable or expensive a stock is.
Yeah, I just looked up Tesla's PE. It's over 200.
Yeah, right, exactly. I mean, Tesla's trading at what, $1,400, and they just started making money. I think, this year. So it's not. I think it's only tens of millions, if that. So Tesla's an example, and Etsy kind of is too, an example of almost like .com era PEs, where, and again, the S&P, and I'm all about the data. The S&P 500 PE of 25 gives you a good measure of what a PE should roughly be. And then I would say the industry gives you a better indicator, but oftentimes it's harder to find industry PEs. So you can always find it. You just Google the S&P 500 PE, but kind of use that as your guide. 25 is a good number. So if you have a PE that's more than that, you're looking at maybe a little bit more expensive company, PE less than 25. Looking at one that's cheaper. If you can find the industry numbers, it's even better. But looking at the S&P 500 PE is definitely a good measure. Brent, if you go to slide 2. So now the question, of course, is how do you make money with this? What this is the chart we're looking at is a percent change chart. Goes back 3 years from 2017 to 2020, and it's just comparing the S&P 500 value ETF, ticker symbol is IVE, to the S&P 500, itself. And looking at this chart right now, what you're seeing is that the S&P as of today relative to 3 years ago is up 34%, and the S&P 500 value ETF is only up 6.5%. So what that shows you is that S&P 500 typically greatly outperforms value investing. But if you look, now that's up today. If you look to the left of the chart, and so that big drop you're looking at is the COVID drop, what happened in February, March. But if you look just to the left of that, you see that the S&P and the IVE ETF, they weren't that far apart. So at that time, the ETF, the value investing ETF was about 20%, and the S&P was about where it is roughly right now, about 34%. So what that's showing is before the COVID drop, they weren't that far apart. So value investing does generally underperform the market, but not typically by a whole lot. Now we're seeing with the COVID drop, the S&P 500 has recovered way more than the value investing stocks has. But historically, they're typically about 5 or 10% apart. Right now, they're 28% apart, which is larger than normal. And I expect that gap to shrink over time. But just know what this is basically showing you is that generally, on average, value investing underperforms the market in general. One thing about that though is you're trading now. Value investing stocks are usually bigger stocks, typically like Verizon, that pay a nice dividend, and they're typically more mature companies. So with value investing, you're going to give up a higher return for a safer investment. So they're way less volatile, and again, they pay that dividend, which is going to pad any losses that you may have in the stock. So when you're doing value investing, as it shows, generally underperforms the market. But if you're more risk averse, this is probably better for you because you're going to get into companies that aren't as volatile as the general market or things like tech stocks.
Yeah, and so some of you all are, listening to us on the podcast. You're watching this now. You're listening to the replay, and you're thinking, okay, what does this have to do with me? Like, am I ready to take on value investing? That's not what we're saying. We're simply saying this is another way to analyze your portfolio. Now, some of you all are ready to, take this on and say, I'm gonna start looking at this more heavily. But our goal in Investing Education Academy is just to bring you all different concepts. And certain concepts are going to resonate with different people. So we're trying to give you as many views on the market as possible. And again, I'm saying this because I know some people are tuning in going, what in the world are they talking about? Or someone's listening to the podcast and driving going, you know what? This isn't for me. And somebody is listening to the podcast going, this is the best thing I've ever heard. So you just have to determine who you are in that space. And don't think that the market isn't for you because maybe you hear information and you're like, I don't know how to process it. Or don't go all in because you're like, you know what, that sounds like the best thing ever. Now I have my direction. That's going to be my strategy. This is not intended. This is not advice on how you should manage your portfolio. This is not advice on what you should do tomorrow. This is an indication, or this is information on another thing to consider as you build your portfolio, as you mature as an investor, or if you are a mature investor, it's just another way to think about what you're already doing in the asset allocation model, or how you pick your stocks. So, just wanted to say that.
Yeah, right. Yeah, I mean, yeah, this is definitely we're definitely not saying this is the end all be all. We're just saying this is and as I said in the beginning, there are generally two ways people invest. They're in value investing or growth investing. What most of us probably know about, the Teslas, the Microsofts, the Amazons, the Etsy's, those are typically growth stocks, and growth stocks are typically defined as stocks that generally outperform the market. So as we see here, by definition, value stocks underperform the market. Generally, they underperform the market. So they're also less volatile, and they pay a higher dividend than growth stocks. So this is just another way to add to your portfolio. What I like about value stocks is they're less volatile, right? So you're not going to have your P&L swinging all over the place with the stock shooting up 10% one day and down 5% the next day. These are very stable, very calm stocks that again pay a nice dividend. They can pay anywhere from 3 to 6, 7%. But you're not going to get those crazy swings like you're going to get in something like a Roku that pays no dividend. It kind of gives you no protection. So and this is another way to add your portfolio but remove volatility. So one thing a lot of people hate is when they look at their some people check it every day or check it every week. You see your account going up and down. By one day you're up 500, next day you're down 300. That's because you're in highly volatile stocks. Something like value stocks will help calm some of that because they're going to be nowhere near as volatile. So they can kind of be a balance to your more traditional Teslas of the world.
Yeah. So I mean, with that being said, guys, it's always that thing that we owe you all, and it's the stock picks.
Yep.
So before we jump into that, is there anything else, Leon, on that you wanted to say?
No, just if you're interested in value investing, and a lot of people they just really don't know it because they're looking for stocks that are quote unquote undervalued. And I say quote unquote because the definition of value varies from person to person. What we just showed you is measuring value based on PE. And as I said, there are many ways to measure value. It can be cash flow, it can be assets, but based on PE, it's a good way to judge if a company is expensive or not. Again, not the end all be all. Don't just look at a PE and say, I'm getting in because it's cheap. That's just one, that can be a starting point. From there, you can then look at other things. But for people that are looking for value stocks or cheaper stocks, or not cheap, inexpensive stocks, value investing is a good way to go, and using PE is one way to do it.
Yeah, and as we get ready to kind of tell you what those stock picks are going to be, what they are, is something we should tell you. This weekend, we have our Hot Seat Saturdays occurring. And Hot Seat Saturdays is when we have one of the members of Investing Education Academy take the hot seat, and they show parts of their portfolio, and they talk about how they invest. This week in particular is going to be really good. This Saturday, 6 p.m. It's for all Investing Education Academy members that are insider or at the Panther portfolio level, because we actually have a tax attorney, Beverly Winstead, who will be taking the hot seat. And so let me explain this. The fun part of having people take the hot seat, and the reason why we have our members take the hot seat, isn't because we're trying to just just figure out everything they're doing. If you hear and you make investing or the talk about investing in the market, and it's specifically the market, part of your everyday conversation, it just changes your relationship with stocks. And that's our goal. It's one of our goals, one of our bigger goals. We want to change our members' relationship with stocks. But when we can have the quality of membership that we do, we have amazing members, and they're very active inside of the platform. So if anybody's interested in joining Investing Education Academy, you can go to www.ieamembers.com. And so the cool thing, attorney Beverly Winstead, she's a tax attorney, and she'll be taking the hot seat this Saturday. And what we've noticed is people are really interested in hearing how a tax attorney manages her portfolio or their portfolio, her portfolio in this case. So we think it's going to be a really interesting hot seat. I hope you all can sign up before Saturday at ieamembers.com so you can participate. And again, it's for insiders and Panther level members because it is a little more intimate. And we want to make sure that when we share this information, not only are people ready to receive it, but they can actually act on it. So you can ask your questions. You can ask, why would are you considering short and long-term capital gains in your decision-making process? How do you avoid, or do you capture losses? It's just a lot of questions you can ask somebody at this caliber. I can't see this happening anywhere else. And this isn't because it's IAA and it's our company. I truly can't see a majority of people having access to ask a tax attorney, how do you manage your portfolio? And last Saturday, we had the Ask an Expert, which is for everyone inside the IEA members platform. And we had a estate planning attorney Cheryl Chapman Henderson, talk to us about estate planning, and it was fantastic. So, awesome. Yeah, awesome. I mean, a lot of questions got answered, and considering, she charges like $300 an hour, that was a win by itself. And again, our memberships range from $36 for the year up to $5,000 for the year. So it's literally something for everybody, because our goal isn't just pay us. We want as many people as possible to get the information about how to be in the market. It's a great equalizer. And we're realizing minorities don't get the opportunity to always have the professional environment they need to stay in the market, because it also requires a certain mindset. So I just had to say that. I'm looking forward to this weekend. I hope you all can participate in the hot seat Saturdays. Bakari Haynes is still our first.
Yep. History making.
Yeah, he's vice principal of a high school. He took the hot seat first and kind of laid the foundation. So we will always be thankful to him for saying yes and raising his hand. But we'll be up this Saturday with Attorney Beverly Winstead. So with that being said, Leon, you want to give your pick?
Yeah, I'll go first. So my pick is a company called Fiserv. It's spelled Fiserv. Fiserv. The ticker symbol. No, it's not. It's not. The ticker symbol is FISV. Today they closed at $98. It was down 1.66%. But today they reported earnings, and the earnings I say they blew out the water, but the earnings they beat Wall Street. So in after hours, the stock was up 4%. And it closed today at 102. So it closed prior to earnings 98. After earnings, it closed at 102. So what they do is they're a global provider of financial services. Their clients include banks, thrifts, credit unions, security broker dealers, leasing and financing companies, and retailers. So they offer general financial services, financing services to those businesses. And their 2-year profits average is 36%, which is great. I usually look for, to me, anything above 20-25% is stellar. They're at 36%. And their sales on average the last 2 years is 72%. So really solid company. They're showing great profitability, great sales, and they serve a ton of different industries. And the one thing is they do not pay a dividend, which I'm fine with, because again, it's such a solid company. I was hoping they paid a dividend, but they don't. And I'm cool with that, based on the research I did for the company. So the company's name is Fiserv. Ticker symbol is FISV.
All right, let me see.
What you got?
So my company is HubSpot.
Yeah, I know that's what.
Are you familiar with them?
Yeah, their stock's up there, right? Price wise.
Yeah. Oh yeah.
Yeah, 2,000. Yeah. Okay.
So HubSpot is they're a developer and maker of software products, but also what I like, I'm not even going through the definition of who they are. I'm just kind of skipping to why I like them. They actually train people on how to use their software platform very similarly to Salesforce, but they focus on digital analytics. And where we're moving, everything is about analytics. And digital analytics are the way to be. I've been tracking HubSpot since 2000. Let me see what the max. I first started watching HubSpot, and I think it was 2016. So they were $51 a share when I first started. Actually, I got some people into it a long time ago. And now they're at $237. And their sales growth has, if you go right to left, it's been similar to the market, lower left, upper right. And so I love the management of the company and their acquisitions. Like they normally take over really small companies and just infuse them into the HubSpot ecosystem, which I'm a fan of. They do not, I'm pretty sure they do not pay a dividend. I didn't check, but they don't pay a dividend.
Being a tech company, probably not.
And this is one of those companies that totally goes against what we talked about today. So if you look at HubSpot's PE ratios, they're probably through the roof. If I had to guess, it'd be like 170 or something. But I think it's a very solid company. What they do is going to be relevant for years to come, and they're positioned well in the marketplace to be a real contender for a top position. So HubSpot, and the ticker symbol is HUBS. And although I know some of you all listening to this, and I'm telling you they're trading right now at $237.80, may think, oh, that's a great price. And some of you all are like, oh, that's too high. They are testing their 52-week highs. So I'm just letting you know. I have zero fear of companies that test 52-week highs, because anytime you look at the historical performance of a company, if they never test their 52-week high, they never go higher than their 52-week high. So I am completely fine with companies that test the 52-week high, and I don't wait for them to go to the lower part of the 52-week high, which is some people's strategy. And if that's your strategy, cool. But I can tell you, when I started following this company in 2017, it might have been earlier, but let's say 2017 to be safe, it was at $51 a share, and it was testing its 52-week high back then. So if we would have said, oh, it's at the top of the market, and now it's at 237, where would we be? So I think they have a lot further to go than where they are right now. I'm a fan of them, and it's HubSpot. You can find the ticker symbol being HUBS. That's my for today.
Just real quick, HubSpot's PE is, it's full. So there's something called trailing PE and forward PE. I didn't get into all that, but just so their forward PE, which basically takes their forward earnings into account. Their forward PE, which goes out a year, is 270. So that is crucial. But now we'll say we're going to cover this probably next week. We're going to cover growth stocks. PEs essentially mean nothing when it comes to growth stocks, because as Brent said, he started looking at this company, a few years back, it was at $51. Now it's at $237. So back then, had you said, oh my God, their PE is 270, well, you would have missed out on, it tripling or whatever it's done from 51 to 237. So for growth stocks like HubSpot, PE doesn't matter. Again, it's only if you're looking for value plays, companies that are more mature, companies that usually pay a high dividend, and kind of the brand names that are typically what value companies are. And again, not saying you can't use PE for growth companies, because as we saw in the COVID drop and even the .com days, a lot of companies typically that are young tech companies, if the market ever does take a hit, these will fall faster than the market does. So that's kind of that risk, with younger tech companies. So it's all about your investment strategy, it's all about your risk tolerance. But yeah, so I just want to throw it out there. The HubSpot's PE is 270, which is high relatively speaking if you're using PE as a measure.
But also too, like when you have companies that have smaller capitalizations, market caps, they tend to be affected by the market quicker than bigger companies, which again, HubSpot is moving into that like strong mid cap sector, and their market cap is about 10 billion. So when you move into 10.3 or 10.7 or something, but when you move into that type of space, it's not an easily rocked company. It can be rocked, and it still be rocked faster than large caps, but it's not going to be a startup or a small cap company. So just know HubSpot, it has some legs under it.
Right, and just for comparison, Fiserv, my pick, its PE is 54. So but remember, you want to measure PE against something. So if you're measuring that PE against the S&P 500, even Fiserv would be considered overvalued. If you're a value investor now, I mean, again, this is going by the value investing term. Fiserv's PE is 54, which is above the S&P 500, which is the general measure of PEs. So which is it's more than double the PE of the S&P 500 at 54. S&P is 25. So somebody just a value investor may say that's too expensive for them. They're going to move on. HubSpot, way too expensive for them. They're going to move on. Again, it's up to you. It's up to what your preference is. But for people that are looking for quote unquote value stocks or relatively inexpensive stocks, PE would say that both of our picks are overvalued. That's if you're going that route. So just know that. And remember, PE is only one way to measure the value of a stock, but it's one of the most popular ways as well.
Yeah, and again, too, if you're looking at any of our picks and you're thinking, oh, I need the cash flow to increase to get it, you can always get fractional shares. And for those of y'all who have asked about the recent Apple split and what either Leon and I think, or what's our position on it, we did a complete video on it inside of the IEA members platform. So if you wanted to see the video, again, our membership start in 36 for the year. That is not per month. That is for the year. And we update our community as much as possible on hot topics so they aren't left guessing, so they can make an educated decision now to drive the revenue up later. So, again, when you look at this, and two, me and Leon's style is not the same the way we invest. And you probably can hear it in how we describe stocks. You can hear it in how we describe our stock picks. But the thing is, we still have a history in this market. And our history has given us certain, wisdom, call it what it is, that we want to share with you all. Because you might not have heard of HubSpot, and I've never heard of FIS. And, I'm looking at it and like, oh, I want to check it out now. So, and it's a global company. So when you're talking about global finance, that's like that's the buzz topic for everybody. So these things, we hope you use them responsibly. We aren't saying go buy them. We're saying start your research. If it makes sense for you, then make the purchase. If it doesn't make sense for you, don't make the purchase. If you have questions about investing, you can always, you don't have to join our membership. You can always go to Investing Education Academy on Facebook. It's our group. Post a question there. As much as we can, we answer the questions. Again, if you just want to, live within our ecosystem on Facebook, go Investing Education Academy, search it on Facebook, our group will pop up. And we look forward to seeing you all next week. Leon, do we have anything that I missed?
No, that was it. That was it. Just value investing. And next week we'll probably cover growth investing, which is the kind of the exact opposite of value investing, which we covered today. And I think a lot more people will be more familiar with that because most of us trade or buy more growth stocks. So that'll probably be the topic next week.
Yep. And if you all have any questions, again, you can come over and visit us inside the platform. We'll be happy to talk to you about anything related to finance. So if you want to come Saturday, you have to join the membership. So Saturday will be the hot seat with Attorney Beverly Winstead. This is going to be a good one, guys. And for anybody who's in the IA membership already, if you can't make it for some reason Saturday at 6, we will record it and have it air inside of the IA Insider and Panther Tribe. It will be there for you all to view later on. Look forward to seeing you all next Wednesday. If you have questions, we'll see you in the Facebook group. For all of our members, we'll see you inside the platform. Bye.